So mutual fund kind of a concept is there since 1964 and LIC is formed in 1956. This is the size of this industry. The total assets which are invested, the valuation of those assets is more than 77 lakh crores as we speak. Still, a lot of people have no understanding or little understanding about how this product works, why the investments are safe, or why they should be done in a manner in which people will find a stable wealth creation journey. And when we look back, that every crisis looked like a missed opportunity.
Right.
So if you analyze during these 30-35 years of history, which we have just discussed right now, the Sensex has delivered more than 15% of CAGR. And if I add dividend, paid by the companies, it will be 16% plus kind of returns.
Welcome to the Bigbucks podcast. Today we have with us Mr. Vipul Shah. So you must have heard the concept called mutual fund sahi hai. But today we are witnessing a roller coaster ride when it comes to global finance. So though it may be the tariffs imposed by Trump, there are wars going on. Gold is continuously shining from past 2 years. So as a retail investor, I am really confused. Should I stay invested with my mutual funds, or should I switch my funds to gold and silver, or should I start my FD? So basically, today we are going to decode the entire mutual fund industry from the basics. Let's understand how these companies are formed, how they work, and why do such a huge amount of people are investing in mutual funds. So we are going to discuss all of this stuff today. Let's welcome our guest for the today, Mr. Vipul Shah, founder of Bigbucks. Bigbucks is currently managing a AUM of 500 crores. They are managing tentatively 4,500 clients across the India right now. So he is definitely an industry expert. So we are going to discuss a lot of things about mutual fund with him. First of all, a warm welcome, Mr. Vipul sir. And the first and basic question, what is mutual fund?
So Prasad, mutual fund is a pooling of investment.
Okay.
By legality, it's a trust and it is regulated by Securities and Exchange Board of India.
Okay.
So when someone invests into a mutual fund, by being a unit holder, he owns those assets subject to the amount he has invested into that asset. So what are rules and regulations which are applicable to trust will be applicable to mutual funds, and what are rules and regulations SEBI stipulates for this kind of a financial product, that will be applicable. So this is what mutual fund is, and these mutual funds are manufactured by, or you can say these products are launched by asset management companies, and they are the companies who are managing these funds which are invested in mutual funds.
Right.
So it is nothing but a collective pool of investment managed by professionals appointed by asset management company on their payrolls as fund managers, and this is how people invest and get returns out of it.
Okay. So you just mentioned that mutual funds are registered as a trust. So could you please throw us light on the concept of trust? Because as you are aware, people are getting, I think few people, those who have started investing in the past 6 months or 7 months, their portfolios are still in red. So they are having the trust issues with the mutual fund. So could you please give the brief history of mutual funds?
So many people feel that this product is hardly launched maybe 8-10 years back.
Right.
And right now tens of
I think mutual fund sahi hai. We are we are listening to that from past 6-7 years only.
Yes. So but the actual thing is, you might have heard, you are from a younger generation, but people who are of your parents' age, they might be invested also. They might have invested earlier also, or might have heard about Unit 64.
Right.
So that was nothing but a product by Unit Trust of India. So mutual fund kind of a concept is there since 1964, and LIC is formed in 1956. So this collective investments are happening in India, wherein people are investing into those instruments collectively. That money is managed by professionals. So this is almost 60 years old concept.
Right.
In 1993, after SEBI came into establishment after Harshad Mehta scam, this instrument was allowed to be launched by private companies. So since 1993, a lot of companies have started this business. You might have heard that they are being acquired or their names being changed or the owners being changed, but they are there continuously or they might be merged. But it has not happened that a mutual fund company has run away. So this is the kind, that is why it is called as kind of it. That is why you should have trust.
Actually, that's very important.
Yeah. So that is why it's nothing but trust. A lot of financial institutions, apart from mutual funds, might have come up and wound up their operations, or fly-by-night operators might be there. But in case of mutual funds, your investments are pooled in a manner and regulated in a manner that there will be risks related to market, but not things related to having big scams or frauds happening in mutual funds.
Right. So that was a very important point basically. So we have understood that the mutual fund industry is there for, we can say, from 1993, right?
For
technically from
players.
1964,
Yes.
But yes, for
Yes,
private players, we are here from
1993.
1993. So yes, we do have the history of, we can say, around 30 years. So you can stay invested. Now let's understand about a lot of, I have heard the word called AMC, that is asset management company. So what are asset management companies and are they different from mutual funds?
So yes, asset management companies are different than mutual funds in a sense. Asset management company will launch a product which will be known as a mutual fund, So that's a trust, whereas asset management company can be a private limited company or a public listed company. The way you have UTI Asset Management Company.
So just to clarify, I mean, mutual fund is a trust and asset management company will be registered as a company, right?
It will be registered as a company. So you will find they might be private. Many of them are now going public.
Right.
So you have Nippon Asset Management Company being listed. UTI is also listed. HDFC Asset Management Company is listed. So what is their business? So asset management companies will launch mutual funds as products. They will garner assets. They will charge fees to manage those assets.
Right.
So their key function is to manufacture a product, or you can say launch a product, garner assets. If they professionally manage it with a lot of sound processes, trust, and if they create or give seamless performances and consistent returns for the investors as per their mandate, then people will trust them and invest more into their products. And naturally, by increasing their assets, they will get the fees. So that is their main business. So what asset management company does is garnering and managing of assets under their belt. For that, they will use different channel to distribute these products. They may have a direct channel, or they may appoint distributors or agents, through which these products can be invested into by investors at large. So that is why that is what asset management companies will do. A particular scheme will be managed by a fund manager.
Okay.
This fund manager is on the payroll of asset management company. Right. So whatever asset management fees are charged by the asset management companies to the fund, from those receipts, or that becomes its revenue, and they will pay the salaries to the fund manager, or bonuses or incentives. So many times people don't understand how this works. So this is how it works. And most of the fund managers in this industry are the best brains in the country. They are highly qualified. They are either IITians, IMCA, CFAs, highly qualified people, or they might have been
and
gone
people
abroad.
With the experience of this industry.
Apart from that, yes, they have huge understanding and expertise in managing those assets.
So tentatively, how many AMCs are there currently in India?
More than 45 AMCs are there, and a lot of them are opening their shops. Looking at the market place in India, in US there are more than 2,000 plus asset managers.
How many active investors are there currently in India?
So in India there are more than 10 crore active investors. The folios, that is the collective accounts which these 10 crores have in different companies, is more than 25 crores, if I am correct. So this is the size of this industry. The total assets which are invested, the valuation of those assets is more than 77 lakh crores as we speak. So, and this is a fraction of bank deposits. It is close to 30% of the total bank deposits in the country. So total bank deposits in the country are close to 2.5 crores. So that is the kind of industry which we are talking about. That is the kind of participation which we are talking about. Still, a lot of people have no understanding or little understanding about how this product works, why the investments are safe, or why they should be done in a manner in which people will find a stable wealth creation journey. So this is it. SEBI is doing and taking a lot of initiative for this. A lot of participants in the market, the asset management companies, the distributors, the registered investment advisors, the entire ecosystem, the asset, AMFI, which is a kind of regulatory framework. Within that regulatory framework, this is an institution which also is supporting this entire ecosystem. So AMFI is there. So all of them are trying to create awareness, bring transparency into this whole system.
So basically, there are a lot of statutory compliances which you are required to follow, right?
Yes, that is why people are finding trust and faith, and that is why the numbers are growing. It is not only because of the returns, but it is because of the processes and compliances. People feel that this is a trustworthy instrument to invest into.
So just to summarize it quickly, so can I say mutual fund is a trust? They will have a AMC, that is asset management company. The AMC will have fund managers. So those fund managers are obviously IITians, IIMs, or a qualified chartered accountants with a lot of experience in the market. And so it is nothing but people who don't have any kind of knowledge about the markets. They will just combine their money and they will outsource their money management. Can I say like it?
Yes, in a way, yes, with a structure.
So whenever I come across any of mutual fund advertisement that mutual fund sahi hai, basically in the ending, they always say mutual funds are subject to market risk. So can I say whenever I am investing in a mutual fund, it is always risky, or do I have any other products also in the mutual fund where I can get guaranteed returns or fixed kind of return?
So the first thing, let's try to understand what is mutual fund. Mutual fund is a financial product.
Right.
It is competing with other financial products.
Okay.
But in Mother Nature, there are 5 elements, right? Similarly, in investment, there are 5 elements.
Okay.
So one is real estate, second is fixed income, that is, the instruments which give you some interest. Third is gold, silver, platinum, diamond, kind of, precious metals.
Right.
Fourth is equity, stocks. And fifth is your cash in, hand or savings account, and money, liquid
money,
funds,
basically.
Liquid money. So money only goes in these 5 basic elements. So mutual fund is a product through which you can invest in each of these instruments. Okay. In real estate, it is not mutual fund. It is not called as mutual fund, but it is called as REIT, or real estate investment trust.
Right.
But nothing but a collective investment scheme kind of a option. So mutual fund is a product in itself. It is not an asset class.
Okay.
When we see this, so ultimately the money will flow into the respective asset classes.
Right.
Now tell me, which asset class gives you guaranteed and fixed return?
The fixed income instruments like FD or debt, I can say.
Yeah. So again, so you are accepting, at least on the face of it, equities are volatile.
Right.
Gold also moves up and down.
Right.
Real estate has its own risk. The prices also go, rarely they go down, but they also go down. Then there are other legal risks and, litigation risk, encroachment risk, many things will be there. In case of fixed income, when we say fixed, tell me, Prasad, let's say you have invested in fixed deposit at 6%. Inflation in the country has gone up. You have invested for 5 years. And now the same bank, after a month or 2 months, is now offering interest rate of 7% on your 5-year fixed deposits, or someone's new fresh deposit. So you are getting 6%, and just in 2 months the rate is hiked to 7%. Do you get 7% rate of return on your old FD?
No, because I have invested at 6%.
Right. So it is as simple as that.
Right.
So this risk is nothing but interest rate risk, right? So even a fixed instrument is subject to some kind of risk.
Right.
Obviously, the deviation might be smaller. I may earn 6, 7, or 8, or 5, something like that.
Impact will be smaller in case of.
But still, nothing is guaranteed. Nothing is fixed in finance, is what I say. Everything is subject to risk, and this risk is nothing but it is called as market risk, right? Now within this band, people feel that whenever I am getting a guaranteed cash flow, that is sufficient for me. But as I told you, in case of fixed deposit of SBI, if I am getting 6% return, then I will get that 6% cash flow guaranteed in a guaranteed manner.
But then in that case, I am not beating the inflation.
Yes, but then it is not fixed in any sense. So everything is dynamic. You have to consider inflation in this. Looking at this, if someone offers you guaranteed and fixed return, then normally nothing is fixed, nothing is guaranteed, but these returns will be very low, maybe 4, 5%, 6% when you have potential to earn much higher return over long term. So in finance, I always say whenever you hear word fixed or guaranteed, be cautious, and that is what mutual fund is highlighting over here. That is why SEBI says, and in every ads, everywhere you will find this disclosure, mutual funds are subject to market risks. Now these market risks are associated with the asset classes underlying those mutual fund investments.
Right.
And obviously, please read the offer document carefully before investing. Now it is normally, the announcement is done so fast, so quickly that people have lost interest in it. But the thing is, the offer document.
But there are many customers who are just, they are stick to that part only. That it is subject to market risk, so I'm not going to invest in that product.
So I'll tell you, the thing is, no bank manager will tell you that the interest rates are going to change soon.
Right.
So he'll not highlight you the risk. Similarly, no developer will tell you that the property prices may go up or may go down, anything, or there are some kind of litigation risk. Now RERA is there and they have to disclose it appropriately, but otherwise earlier it never used to be disclosed. Now if you see, no goldsmith will tell that don't buy gold today, it is going to fall in couple of days. So it's very strange that people participating over here have to state this. But what has happened is, because of this, a lot of checks and balances are put by the people who are into this ecosystem, who are advising or distributing or manufacturing these products for investors. A lot of disclosures are built in, and this word is this phrase is well-meaning, and SEBI has clear intentions with an investor-centric mindset that the product has to be understood, the risk has to be understood by the investors before investing. So yes, we sometimes feel that this word itself is killing the potential investors coming into mutual funds, but nonetheless, those who are there and those who will come over here, they will have a quality experience because of these kind of rules and regulations in place. It's a wonderful ecosystem to have and to get into.
Right. So as you just have mentioned, to clarify and to quickly summarize, correct me if I am wrong. So basically, mutual fund is a financial product which can invest either in debt or in equity or in gold or in any sort of other asset class. So according to my risk appetite, I'll decide where I want to go, or as per the advice of my whoever the financial expert might be there. So he will decide for me that for should I invest in a debt mutual fund, should I invest in an equity mutual fund, should I invest in a multi-asset mutual fund. So basically, mutual fund is offering you a number of options. Now you have to decide what is your risk appetite and where you should invest. Am I right?
Yes.
Okay.
Correct.
So basically, there was a misconception about the mutual fund that all mutual funds are risky. It is not like that. Yes, every financial product has some sort of risk, but if you know your risk appetite, then you can choose or you can opt your product accordingly. So let's move to the next question, sir. One more misconception is there, sir. If I am investing my money in the SIP, you must be aware that now there is a buzzword SIP and many of the people are already aware about it. But many people come across to me and say, sir, I am not doing mutual funds. I am investing in the SIP. So SIP and mutual fund is one and the same or different?
So Prasad, here you must have heard that people go into a shop and ask for Colgate.
Right.
Or they ask for a Cadbury.
Right.
They do not ask for a toothpaste, or they do not ask for a chocolate.
Right.
Similarly, here in mutual funds, the way SIP is made popular, a lot of people have started feeling that SIP in itself is a product.
Right.
Rather than it's a way of investing in mutual funds.
Okay.
So it's just a cash flow mechanism.
Okay.
So SIP is systematic investment plan.
Yeah.
You can invest weekly, fortnightly, or even on a monthly basis. The way you have recurring
Can
deposits.
I invest daily?
Yes, daily SIPs are also launched.
Okay.
See, with technology, this product is amazing, and a lot of investor-centric measures are being taken. Whether this will help, whether the frequency matters or not, we have a lot of studies regarding this, and I have a different opinion, but this is not the topic of today's discussion. So the thing is, SIPs are popularized in a way and understood in a right manner, but sometimes people have lost that the understanding and whole meaning of mutual funds, and SIP is just a way of putting money in mutual funds. The way you have SWP, which is nothing but systematic withdrawal plan from mutual funds, which will very soon probably start competing with your pension plans, so-called pension plans and other kind of mechanism wherein you get regular cash flow. Again, STP, systematic transfer plan, switching from one fund to another fund. So these SIPs, STPs, SWPs have become buzzwords and will become buzzwords going forward, that people will forget about mutual funds. But as long
I
as
think the credit goes to that campaign, mutual fund sahi hai, right?
yes,
Yeah.
so and the credit also goes to those I will say distributor advisors who have
Right.
promoted SIPs and created wealth for people, and now people don't even understand and know from where this wealth has been created.
Right.
They have seen this kind of wonderful compounding, especially in equity mutual funds. So the whole idea over here is to promote the right product, but sometimes even if the mechanism is popularized and takes over, doesn't harm us as long as people are creating wealth and they are investing in right instrument. So it doesn't matter whether SIP is bigger, in the minds of investors or mutual fund. But yes, for understanding purpose and clarity, it is important to understand that SIP is way of putting money in mutual funds, just a way of investing cash flows in mutual funds in a systematic manner.
Okay.
And sooner or later, people will come to realize that SWP will become a next buzzword.
Right.
We'll have another discussion because this is another topic which is close to my heart. Systematic withdrawal plan may replace your regular, earning sources which you think in your mind, because of its suitability, because of its liquidity and other things.
Okay. And the most important question now, sir. A significant amount of investors are currently stopping their SIPs because of the global turmoil. You must be aware that gold is continuously shining. So I am also feeling that should I stop my SIP and convert my money to the debt funds or say gold funds? So what would be your opinion on this?
So if it is equity mutual funds, I'll take you back to the history because I am a student of history. I love history. I was fortunate to have a very good, teachers in my school when we were studying history. So in 1991, our economy got opened up thanks to the then Prime Minister P.V. Narasimha Rao,
right.
and then Dr.
Manmohan
Manmohan
Singh,
Singh,
yes,
who was
yes.
finance minister back then. They opened up the economy. Because of that, the inflation, there were some short-term side effects. And economy saw a lot of inflation. And 1996,
I think in the school we have learned that LPG, that is liberalization, privatization, and globalization.
Yes.
So you are talking about that only.
Yes, and that liberalization led to some, some side effects. It is bound to happen, right? Because when you have major drastic reforms, naturally there will be some consequences. In 1996, we saw significant inflation, and the government of that day got changed during the elections. And then we had mixed governments. So the governance or continuity of the same was in question. In 1997, long-term capital management, one of the globally acknowledged fund, went bust. It was run by Nobel laureates in economics. So their model had factored.
Why? Could you please elaborate on that?
Actually, their model had not factored in one assumption that the governments can default, and Russian government defaulted back then.
Okay.
It snowballed into East Asian currency crisis. So we had major fallouts in 1997. In 1999, dot-com bubble burst happened. Technology stocks went burst. In 2001, there was grave terrorist attack on the US, right? Post that, because of that attack and measures taken, the world went into recessions. 2003-4 onwards, we saw huge rallies in global markets, but 2008 Lehman happened. Subprime crisis and Lehman crisis happened. Then so-called policy paralysis, corruption charges. Then again, you can see 2016 demonetization happened. GST, RERA reforms were rolled out. Economy was struggling during certain phases. Then COVID happened.
Right.
Then you saw this Russia-Ukraine crisis.
Right.
Then Israel and Palestine conflict going on. Then we had our own conflict with Pakistan.
Right. Currently the tariff war.
So during all these times, every time we felt that the markets will crash.
Right.
There will not be money on the table. Rather, whatever we have invested, we will lose. And when we look back, that every crisis looked like a missed opportunity.
Right.
So if you analyze during these 30-35 years of history, which we have just discussed right now, the Sensex has delivered more than 15% of CAGR. And if I add dividend, paid by the companies, it will be 16% plus kind of returns, which are far higher compared to the instruments which were available back then.
So considering all the market crashes as well.
Yes. So if you analyze, way back PPF was one of the popular instruments. It started with 12%, now it is at 7.1.
Right.
So average, even if I assume 8-9%, this has delivered much higher returns compared to, I'm just talking about Sensex. Since 1993, though you need to taper down your expectations, and this is not a guarantee of any future returns.
Right.
The funds which are launched in 1993, they have delivered more than 20% plus CAGR, and almost 24. And if I apply rule of 72,
right.
Your money has doubled every 3 years.
Right.
For last 30 years,
right.
that is huge compounding.
Right.
That is unheard of.
Right.
If I may tell you example of Infosys, in 1993 it came into the market and it has delivered close to 40% plus CAGR since then. But a mutual fund, which is a portfolio of stocks, delivering more than 20% returns for 30 years is unheard of. Right. That is the kind of massive wealth creation which has happened in the industry. Again, there is a disclaimer that mutual funds are subject to market risks. Please read the offer document carefully before investing. And past performance does not guarantee future performance in any manner. But this is the history which has happened. So I'm just stating the facts. I'm not saying that this will happen in future. But this is what has been done already. That kind of wealth creation has happened, and this has led to creation of wealth for not only investors who were high net worth individuals and those who were rich. This has been done and happened for people who are retail investors who have started with a small investments in mutual funds, maybe 500,000 rupees, small SIPs. They have seen this kind of wealth thanks to the choice of right asset class and right mindset. And the irony of that, I will say, is yes, there is huge wealth which has been created, but still there is a gap between investors' return and investment return. Right. The so-called, rather not so-called, the actual behavioral gap. And a lot of work is being done there by regulators, by the manufacturers, that is asset management companies, by the investment advisors and distributors in this ecosystem, so that investors can remain invested for longer term. Right. So earlier the average age of a folio was less than 3 years. Now it has been increasing regularly. Right. So investors are staying back even in underperforming schemes. They have understood that they also have their own cycle. So investors are maturing a lot.
So basically, as you are mentioning the history, I think if you are staying invested, it will obviously lower down your risk.
Yes. So I will say it is the risk will be inversely proportionate to the time you remain invested into the market, or the instrument. So in equity instruments, if you remain invested for longer term, risk is another, volatility is another measure of understanding risk. Right. So the volatility in returns will be much lower. You will get a stable, compounding, consistent returns if you remain invested for long term. Right. So just increase your timeline, of investing, and as Warren Buffett says that you marry the company in which you remain invested. I know it's very difficult. Nowadays, marriages also don't last.
No, we are not at all that patient. If you consider the Gen Zs like us, then the basic question which I have, you just now gave the example that Infosys has compounded at somewhere 35 to 40%, and mutual fund, the best of the funds, have performed like 24% per annum. So why should I not directly invest in the stocks and go through the mutual fund way?
So the thing is, I just told you about example of Infosys, right? Similarly, there are many other failures.
Right.
So if you analyze,
failures are not often discussed, right?
Nobody discusses
it,
right? So only successful people, successful businesses, and success stories are there. So we see one Usain Bolt, but there are many people or lakhs of athletes who might have not reached to the level at which Usain Bolt competed. So the thing is, you look at Nifty today. Out of these 50 stocks which we see right now, more than 100 have come and gone out of Nifty.
Right.
So Nifty has seen constant changes in its constituents and even the weightages.
So basically, it is very difficult to identify the winner.
Yes. So what a fund manager does, even he his bets are often right by only 60%. So he doesn't also get 100% right bets in his portfolio. So for him also the success ratio is relatively lower. The thing is, he invests into those compounding stories for sufficiently longer period, and he has that mindset, behavioral, traits. He obviously has research and analytical capabilities,
Right.
but knowing doesn't help in generating higher returns.
Right.
You have to know, you have to practice that,
Right.
and you have to remain invested.
Right.
Investment is a very boring game.
Right.
So when I say you invest and for 10 years, 15 years you don't do anything, people feel like then they feel that they have lost the control on their investments.
Right.
The real fact is, the only thing is, you do not have any control. Whether you invest 1 rupee, 10 rupee, 100 rupee, 1 lakh rupee, 1 crore rupee into a fund is not going to determine how much percentage returns you will get.
Right.
But what happens is, if I increase and improve my bets, I feel that I should have the control.
Okay.
This is a psychology which common investor has.
Yeah.
So when he feels that DIY, do it yourself. So if I can invest in mutual funds, or if some mutual fund can create this kind of wealth, how can I not do it? This is what many people feel. But just do one simple thing. Copy Warren Buffett's portfolio. Do you think I can become a Warren Buffett?
No, I don't think.
So
You
because
need that mindset, right?
yes, you need that mindset. You need to do that, and there is some portion of luck also.
Right.
Some portion of timing also. So doing all these things is very difficult.
Right.
In Gujarati, there is a famous saying, "Jeno kaam teno thai,
Right.
duja kare so gotha khai." So
Right.
if someone else does your work, he'll struggle, right?
Basically, you cannot play better cricket than Virat Kohli, so it's his job. So let him do that.
So I'll tell
Right.
you another thing. You can see, a video of operations on YouTube. So can you operate on your own? Can you give yourself anesthesia or do anything and operate? The answer is no. So if you have a common cold or flu, you can take over-the-counter medicines, but otherwise you have to go to the experts. Similarly, you have to do it in the case of money. I understand life and money are different. So
Right.
when life is at stake, you have to go to doctor.
Right.
But people don't feel that their money is at stake by not taking right advice or not going through a proper channel. What is a mutual fund? It's a collective investment. Crores of or thousands of crores are put into one fund, and a fund manager invests that money on your behalf. Now, if you see, he is not the sole decision maker. There are investment committees. He also has a team of research analysts, associates backing him. He also gets outside research from other people. So, if you analyze, a lot of ecosystem is put into his decision making. To replace that decision making is very difficult. And what happens is, a person in lakh can do that. But then people think that if he has become successful, why can't I?
Right.
Yes, it is right notion to have that, but you have to be realistic also.
Right.
He has spent his time into that. He has spent time into researching, investing, meeting the management. If you see Warren Buffett, Rakesh Junjunwala, they have analyzed the company's quarterly results. They attend con calls. They have visited the plants. They have discussed.
They are actually married to the company. Right?
Yes. So this thing is not done by common investors. That is why we suggest. So I'm not investing in, I'm not against investing in equities as an asset class. What I am saying is, understand the pros and cons and then take your conscious call.
And I think investment is a full-time job. I mean, I'm a student or I'm having a job, and along with that, if I'm planning to plan my investment, it is not gonna be an easy job or an easy task for me, right?
Yes, it's very difficult.
So basically, I am having a product like mutual fund. They are offering the nominal charges and they are managing my entire money. So it would be rational to go with them only.
Yes, that is why you have this kind of a mechanism.
Right. So we have understood the industry of mutual fund today. What are the mutual funds basically? What is AMC? Who are the fund managers? We have understood the basic and brief history of the mutual funds as well. And thank you so much, Vipul sir, for elaborating in such a simple language. We'll understand few more things about the mutual fund in the next episode. Stay tuned, stay invested. Thank you.